DCB Bank. Their NII, PAT both have seen a jump up on a year-on-year basis. The asset quality as well has seen an improvement, although just marginally. So let's try and figure out what the quarter gone by was all about and what's the anticipation and expectation going forward. We have with us Murali Natrajan, the MD and CEO at DCB Bank, joining in on the show right now. Mr. Natrajan, good morning. Welcome to ET Now. Just going through your numbers, sir. Your loan growth is strong. Tell us a little bit about which part of the book is growing and what's looking secure to you right now.
Good morning and thank you for having me in the show. Our plan is to double the book between 3 to 4 years. We are a retail and SME focused bank. More than 80% of our loan book is average ticket size of below 3 crores. So it's a very granular book, and in line with our strategy, we are continuing to build our mortgage book, agri-inclusive banking, which includes tractors, KCC, gold loans, SME, MSME, working capital loans. So those are the focus areas and exactly where we are growing. We are focused very less in corporate lending. Our corporate lending is only about 10%. And we have secured lending. Almost 80-85% of our book is secured lending. And that is also the reason why you see that our quality of the portfolio is consistently improving over time after the COVID kind of challenges that we faced.
Okay. Now, despite this, we've seen your despite this secured book, your slippages remain a bit elevated, as do your provisions. What's the reason for this, and how are you looking at these two numbers and these two metrics going forward?
So I would like to make 2-3 points on that. First of all, if you look at our collection efficiency data that we present, both on non-delinquent book and delinquent and structured book, the collection efficiency is pretty close to 98-99%. That tells you that as the environment is improving, as the portfolio quality is stabilizing, we expect slippages to go back to pre-COVID levels in maybe 2 or 3 quarters. If you look at the slippages without the gold loans, it is already at 2.88%. I think pre-COVID our slippage used to be 2% or 2.25% of the opening book. So we are confident that as the situation has improved a lot and continues to improve, and as we build our portfolio, our slippages should go back to pre-COVID levels. On credit costs, we are at about 34 basis points. Our business model, we have constantly maintained that is about 40 to 50 basis points is our credit cost. We are confident that the kind of portfolio that we are building and that we have, we should be able to maintain that levels of credit cost. And if I might add, our intention is to bring down the gross NPA to 2.5% and net NPA below 1.25%. And it seems like a very achievable kind of goals.
Very categorical with all those targets, and I'm sure the market was awaiting, some of those numbers. Now, going forward, I want to also understand the piece that's impacting your operating profit is your elevated Opex. So what is it exactly that you're investing in? What is your near-term cost-to-income guidance?
Our cost-to-income is likely to be 55% or below. What happened is that in the 2 years that COVID impacted the self-employed segment, which is our core target market, our growth has been CAGR only 7%. Whereas prior to COVID, between 2010 to 2020, CAGR growth was 22%. We are putting the bank back on a strong growth trajectory. This requires frontline investment. So we are adding people in mortgage, home loans, CASA, gold loans, agri-inclusive banking. These take time for stabilizing and paying back. And that is the reason cost is elevated at about 64%. We have gone through this between 2015 and 18 when we added 150 branches within 2 years. And we demonstrated very categorically to the investors that our cost-income ratio can be brought down with growth of the book to 55% or below. I just want to say that retail SME banking will always be slightly higher cost income ratio than traditionally what we believe should be the cost income ratio of 45-50%. So we are confident that given the investment and the productivity that we are achieving, over time we should be able to bring it down to 55% or below.
Now, your non-interest income as well has fallen on a year-on-year basis. What is the outlook on that number as well as your fee income growth?
We want to grow fee income by at least 15-18% year on year. What has happened between last year and this year is two factors which are slightly out of our control. One is that once in a while you get the trading gains on government securities. Interest rates have been going up, so obviously we haven't been able to make that gain. Fortunately, we haven't lost money either. Second is our bank, the focus of self-employed segment gives us an opportunity to generate almost 60-65% of loans in PSL category. And there is demand for PSL assets in the market. And that has a rate through this PSLC certificate pricing. Unfortunately, the PSLC certificate pricing has been very soft this particular year. So we have had a situation where the income that we generated last year, we are generating far below that in this year. I don't believe that that trend will continue in the next year or so. So that should bounce back. But having said that, the granular fee income like cross-sell to customers, CASA related fee, processing fee, remittance fee, all those are performing quite well, and we are confident of achieving 15-18% growth in fee income.
Mr. Natrajan, good morning. We've talked a lot about credit growth, and it's a common trend across banks that we've seen credit growth go up. Now, what also has the Reserve Bank and the government worried is deposit growth not keeping pace. However, if I were to see DCB Bank, the deposit growth is healthy. What's your trajectory of forward-looking statements that you can give as far as this segment goes?
See, if the way I explained that we are aiming to double our balance sheet in 3 to 4 years, we will have to double our deposits as well. We are adding about 25-30 branches year on year. We are adding more people to our existing branches depending upon the opportunity of each and every branch. We have a differentiated pricing in our savings account offering. We are trying to introduce newer savings account and deposit products. And given the focus that we have on the front line plus the scorecard of the branches, we are confident of generating deposits to support our loan growth.
Okay. We're going to leave it at that. Thank you so much, Mr. Natrajan, for being live with us today to take us to the fine print of the numbers as well as, of course, the road ahead. So that's DCB Bank for you, higher by about 0.2%.